Hey there, it's Niels. I just wanted to take a minute today to talk about this new Code Section 168N. So Code Section 168 is where like bonus depreciation lives, and something that is really huge for businesses that are starting or expanding and find themselves in the manufacturing space is this Code 168N that passed and became law in one big beautiful bill. It basically is saying that if you acquire new real property that you're using for manufacturing, you can deduct 100% of the cost of that property in the first year. And that's real different than a lot of our past rules around real property. We, as the years have passed on, we've gotten some really favorable stuff around real property where qualified improvement property you potentially can take bonus depreciation on, but that's usually like a leasehold improvement portion. It never included like new space, new, exterior walls, etc. Where this 168N change allows a taxpayer to fully deduct the entire cost of their manufacturing real property. And so stick around. I'm just going to talk through a few of the nuances. Yeah, don't hit click stop right now and go buy yourself something. There's a few really important factors that you must consider if you're trying to get this tax strategy going. And also, as always, if you're enjoying what you're watching, go ahead, like and subscribe. It really helps me get in front of the camera and keep doing this. So, number one big change. Generally speaking, if you've been in business for a while, had a CPA advisor, lawyers, we generally advise you to not acquire real property or appreciating assets in your operating company. So if you file a Form 1065 for a partnership or LLC return, or you file an 1120S for an S Corp election, and or you're filing an 1120 for a C Corp, and you do ordinary type things in that. So you construct, you manufacture, etc. We're usually saying, hey, you should not, under any circumstance, buy appreciating assets, which real property, buildings, land, things like that, in our eyes are appreciating assets. But we also kind of tend to steer you away from buying things like stocks, mutual funds, and bonds for the same reasons. And one of the major things that needs to be present for you to be able to take advantage of this 100% deduction is that the operator and the owner of the property have to be the same. It cannot be set up as a lessor-lessee situation. The lessor is unable to take this deduction. So, if standard 101 business, you'd run off with your attorney or your realtor and you'd go buy this thing in the name of a holding company. There's maybe some gray area out there still about potentially setting up a disregarded holding company, a disregarded entity holding company, just for a little legal protection. Some of the pundits and commenters on this would say, don't write a lease between this holding company and yourself, because again, the lessor is unable to take this deduction. So right now, our understanding is that if your manufacturing co has to be the owner of this property. Another thing that's very important is there's this anti-abuse rule they baked in, which I believe is from like January 2021 to sometime in mid 2025. The property you're acquiring or building could not have been prior used for manufacturing. The whole idea of this rule is that we stimulate the economy by getting people to go invest in real property and manufacturing facilities in the US. So they don't want, company A buying from company B an old manufacturing facility, propping it up as new and getting a giant deduction. They really want either, warehouse space that's just sat vacant for years and years, or land that's been vacant. They want newly built manufacturing facilities on that land, and for doing so, this law is set to reward taxpayers with 100% bonus. Another thing, it's only the property that's eligible for this deduction is only the property that is being used for manufacturing. There's a few other little areas that are going to be allowed under this law, but it's only for the area that's used for manufacturing. So if you're like a brew pub and you have a lot of restaurant area and, you know, customer seating area and retail area, only the portion where you're manufacturing and producing beer would be eligible. And so you'd have to have some kind of reasonable allocation to allow for the 100% deduction of that area. You may have other available deductions, but you can't just take all of it because you do some manufacturing. You need to understand kind of the mixed use space and allocation of the costs associated with like the restaurant equipment and the retail area versus the actual manufacturing area. Another big thing in this rule is that it's got a 10-year look back. And so this isn't park your large, you know, income from this year or next year into a new space and prop up some kind of manufacturing facility that maybe you don't really have intent of carrying on that long. Even if you sale or exit, you potentially have a recapture that you're going to trigger if you don't occupy and like maintain the manufacturing activity for 10 years after you do this. Another thing, it's for tax years 2025 through the end of 2028. So this isn't like a permanent thing. You got to kind of go take advantage of it. It could get extended like a lot of tax rules, but I don't have the crystal ball on that. Other areas, there's some caution to taxpayers. You know, if you go do a $10 million crazy facility and you're a brand new manufacturer, you may get stuck with a large net operating loss, NOL, because you don't have the basis or the income from other sources to fully take advantage of that deduction in year one. And so since the Tax and Job Cut Act around 2018, we've had this net operating loss limitation where you can only offset like 80% of your taxable income with your NOL. And so it may not be the most advantageous thing if you're not able to utilize these deductions fully in year one. And those are things you should definitely be talking about with your tax advisor before you just go and like pull the trigger on this thing. I think that's what I wanted to cover. I might do a little more thoughtful long form video on this at some point, but I just wanted to get some thoughts out there on this because it really is kind of a very lucrative opportunity for businesses who are looking at starting up manufacturing and or looking at expanding manufacturing facilities that they already own. We haven't had something exactly like this. We've had again, I mentioned in the video earlier, we've had some favorable things come around, whether it's qualified improvement property. We have this 179D where you can take some good deductions around improvements made to a building that increase the environmental friendliness, if you will, or like the efficiencies around, you know, air conditioning and insulating roofs and all that. But this is really just like straightforward. If you're going to say the building's 100% manufacturing, all that real property, so all the slab and foundation and walls and everything, all the costs going into that are going to be 100% deductible. Again, my name is Neil. If you found this video helpful, please click the like, comment, subscribe. You know, I'll watch for your smoke signals. And otherwise, yeah, I might do an update on this. It's a very new rule, law, and we're just still waiting on a few things to get discussed on this to see how it's gonna fall at the end of the day. Again, thanks for watching. My name's Neil. We'll see you later.